What's up, everybody? Been a little while. Hope everybody's doing well. Um, yeah, I've been very busy. We have a property management company, and I've been hard at work, kind of putting some new processes in place, and so we could have a better company, serve the community better, help our clients better. So that's kind of what I've been busy with the last few months. I've made a lot of videos for that, training videos, but I haven't really had time to make these videos, and I miss making them. And I said I'm going to do a video today, and I'm really excited about that. So one of the things that we've spoken about many times in the past on these channels is the overall economy, right? Interest rates, stuff like that, and how it all relates to real estate and investing and stocks and crypto, everything like that. Big event happening tomorrow. So let's get this on the screen. What is the big event tomorrow? All right. So tomorrow is the big day that everybody thinks that Jerome Powell, the Federal Reserve Chairman, will finally lower the interest rate. We've been saying this forever, guys, right? When is he going to drop the rate? When's the rate going to go down? And what does it mean, right? Because a lot of people are going to tell you, hey, look, he's going to lower the rate, and then mortgage rates are going to come down, and real estate's going to go up. Not quite, right? It'll help. That's part of it. But I'm going to show you here today what's really going to drive the markets as the rates come down, okay? So right now, what this chart is right here, this is what the market is betting, okay? 53% chance, greater than 25 basis points. So basically a half a point drop. More than half the market's betting on that. The stock market's been going crazy. Everyone's betting on that. If it doesn't happen, I hope you have cash because you'll buy a lot of stuff on sale tomorrow after 2:30 when the rate announcement is made, okay? It's so crazy that Elizabeth Warren, don't get me started on her, decided to write a letter to Jerome Powell demanding that he goes 3/4 of a point. Okay, what's coming up in November? Why would she even think of that? She's in a tight race with John Deaton. Shout out to John Deaton. He's a big crypto guy. He's running against her. Do your own research on that one. Okay, but she really wants that rate to go down a lot because she thinks it'll help her. All right, so one of the things that I want to share here today, all right, Warren Buffett, everybody knows who he is. He has a quote, okay, and it sounds so cool when people share it on Facebook and Instagram, right? Be fearful when others are greedy, and be greedy when others are fearful. So what does that mean, okay? And that's kind of what I'm going to lead into today and what I think is going to happen as a result of rate cuts and how it's going to impact real estate, okay? So when everybody else is being greedy, that's usually a sign of the top of a market, and you should be fearful and sell, right? And it works the opposite way. When everybody is fearful and the world is ending and, oh my God, you should run into that burning building. If it's a good investment, your thesis hasn't changed, that's when you buy stuff on sale, okay? When everyone thinks the real estate market's going to crash, and unless there's some specific reason why that totally debunks the thesis, that's when you buy things on sale. When the stock market's going to crash, when Bitcoin's going to crash, whatever it is. And it sounds so cool, right? When you share this and you're like, oh, be greedy when others are fearful. That's very hard to do. It takes a lot of intestinal fortitude and a lot of courage to be greedy when others are fearful. And, but we all know, like, we all want the same things, right? But it's hard to do that. And I'm going to show you why, okay? So getting back to the rate, when did the rate start going up? Well, March of 2022, about 2.5 years ago, they started jacking up the rates. Now, if you look at my charts, there's a couple of things you got to see because they tell you a lot of information, okay? So you can see right here, you have these thick blue lines. These are trend lines. So the thicker the line, the more strong the trend. Blue is an uptrend, orange is a downtrend. And these little thin blue lines here, these are the actual indicator, okay? So this is the Fed funds rate. So back in 2022, we all know what happened with C19. The rate was basically zero. I'll show you on the next slide exactly what coincided with this decision. Rates ratcheted up. They've been about the same, 6-7 months. They haven't raised them, something like that. All right, so what happened? Why did the rates have to raise? The only tool the government thinks they have to stop inflation is interest rates. Raise rates, make money more expensive, people will spend less, prices will come down. That's their thesis, okay? This is the CPI chart that they release every month to talk about inflation and tell you where we are. Okay. So again, March of 2022 was right here, the peak, right? Look at that trend line for inflation, right? We got all the way up to 9% inflation. Now, this is year over year. I made a lot of videos on CPI. It's very problematic. There's a lot of things that are bad about it. It's a very misleading indicator. Okay. But we're just going to roll with it today because it is what it is. This is the number they're using. Okay. So they got inflation down to their target recently, which is right around 2.5%. So they feel like, so this is kind of coinciding. This is their tool. But the tool is really don't spend more money. And we'll get into that in a second. All right. But this is the year over year CPI chart. But let me just show you cumulatively, because that's what matters to us, right? Just as an aside. Okay. Over the last 5 years, from before C19 to today, so 2019 to today, all right, CPI cumulatively is up 22%. So things are 22% more expensive. And again, this is a very sandbag number that they put out. We all know pretty much everything we buy in the last 5 years has gone up way more than 22%. But we'll roll with these numbers because these are their numbers. 4.4% a year, okay? So, like I said, interest rates, inflation, that's the tool that they think they have. But the real tool for inflation is don't spend more money, right? Stop spending money because, oh, wait a minute. Sorry. One more. So live TV, guys. All right. So really quick, we know that inflation's up. Okay. Why don't spend more money, right? So there you go. That's our national debt. Our national debt's $35 trillion. That's our debt. Okay. So we'll just go right to that. That's the debt. We all know it. It's a very hot topic this election season. It's coming to a head. Okay. So what happens with the debt and how does that rate impact the debt? That rate is the amount of money that the government pays on the interest on our debt. So if the government rate is 5.3%, which it is right now, that's the interest rate that they have to pay on the debt. So they're literally printing money to pay the interest on the debt that they created by printing money. So that's where we are today. Over $1 trillion this year we have spent on interest payments on our debt. It's up 86% in 5 years. It goes up 17% a year. That's their numbers. Okay. It's only going to go higher. So that's why the high rates are bad. That's why Elizabeth Warren and a lot of them are sending letters to Jerome Powell to lower the rate. And that's why the government can't afford to keep the rate high. They finally got their headline number, which is this CPI number right here, down to where they said they wanted it to be. So I think that's why the market is so bullish on a rate drop tomorrow. Now, what does that mean for real estate? Everybody wants to say, oh, this is what everybody who took a 40-hour class and passed the test will tell you, okay? Oh, man, if they lower that rate, then the mortgage rates will come down. And if the mortgage rates come down, then real estate will go up. So you need to buy now when the rates come down. Again, fearful when others are greedy, greedy when others are fearful, okay? I would tell you guys, mortgage rates already peaked. Mortgage rates have been dropping since April and May. They got almost to 8%, 9%, right? They were up there. They've been dropping steadily since May, okay? Banks are in the business of doing mortgages. It's a race to the bottom. If your rates are too high, nobody will borrow your money and pay those rates, which means you won't make any money, which means you go out of business, okay? So rates have kind of already come down, and I think the banks know too, this is coming, right? So who can get ahead of it and capture some of that money as soon as possible? So what is the real effect on real estate, right? The rates will come down a little bit, obviously, but what is the real effect on real estate, okay? And it goes back to my Warren Buffett thing, okay? So right here, most people want passive income, but they are scared to run into a burning building, so they take less for a guaranteed return. Now, that's a lot. What does that mean, okay? Every bank around, and just Google it, and this was a quick Google of CD rates, right? Just, every bank knows, okay, if you lock your money up with us, we'll pay you a return. So people are willing to take 4%, 5%, risk-free, right? That's what they call it, risk-free, right? So what happens, right? If the bank's got to pay the government 5.3% to borrow their money, but they can pay you 4% to borrow your money and loan it out at 7%, what do you think the bank's going to do, right? And banks figured this out early on. A lot of online banks figured it out, and they started offering money. So how much money do you think is tied up in this? And what happens when the rates go down and banks don't want to give you 4 or 5% on your money because the government's going to loan it to them for 3.5%? or 4%? Why pay you 5 when I can get it for 3? So it works in the opposite way when I can get it for 3. So it works in the opposite way too. Okay, $6.3 trillion, according to this report, is tied up in money market accounts, treasuries, CDs. That's how much money is sitting there risk-free, right? Because when the building's burning, all right, a lot of people are scared to run into a building burning. So they'll take less for a guaranteed return. So people think, hey, I can put my money, look at this example right here, because I'm going to go into it in a minute. This bank is offering a 5-year term at $50,000, no minimum, but this is their number at $50,000, all right, 4.1%. Okay, that money is going to be looking for a new home, okay? And where is that home going to be? My thesis is the traditional safe assets will come back into vogue, which means that money will start going to real estate, start going to certain S&P 500 funds, go into other things. I'm going to show you how much they lost by not being greedy when others were fearful, okay? But let's just work with these numbers. So we've established that inflation in the last 5 years averages 4.4% a year. And we'll use this example that they're bragging about at $11,126 on a 5-year CD. So let's take that bet and do the math, okay? So a CD account, you open it up right here, you put $50,000 in it, you make 4.1% free money for 5 years. It's worth $61,000 at the end of 5 years. You're like, wow, I made $11,000, okay? But let's just see what that $61,000 at 4.4% a year inflation, which I would argue inflation is way higher than that, but we'll use that number. Okay, at the end of 5 years, it only has $48,000 of buying power. So you've tied your money up for 5 years, right? And you thought you made $11,000, but you actually cost yourself $12,000, right? Your money's worth less. It's a 20% hit. You lost 20%. I would argue inflation's 14, 15%. They're giving you 4, making 10. And that's what's so bad about inflation. And that's what makes me so mad, because they play with those numbers. So anybody who's been chasing these CDs as a short term, like, hey, you got a bunch of cash. Like I said, if the rate doesn't drop tomorrow, right, and you got some cash, you ready to deploy, these avenues are okay for short term. Right? You park your money for a month or two waiting for an opportunity. As a long-term investment strategy, inflation will eat you alive. All right. And this is the advice that people were giving out last year. Okay. This is from Reddit, right? This is where people go for advice, but this was all over. I've seen this everywhere. For the first time since 2008, homes are now a worse investment for investors than simply buying a U.S. Treasury bond. Investors are now incentivized to sell their investment properties and no longer have any reason to buy real estate over treasuries. This is what people were saying a year ago, 2 years ago, because of the free money, which we just proved is not free, right? So what happened? What if you bought real estate 5 years ago? Where would you be? Let's skip ahead to that one, all right? Home prices over 5 years have averaged a rate of return of 11%. So this is this Case-Shiller Housing Index, national index, all right? From 2019, before C19 happened, to today, home prices are up 54% on average, cumulatively over that time, 55, so it's 11% a year. Okay, you put $50,000 down on a home over those 5 years at 11% return. The value of your $50,000 is now $84,000. You made 68%, all right? If you put it in the CD, you lost, right? You think you gained 22%, but you really lost. You're negative 20. So it's like an 80% delta, 90% delta. So all these people telling you not to buy real estate when it was cheap because everybody was scared to buy it because people thought the world was going to end because the rates went up, and all these kind of models that people built in 0% interest rate environments no longer work. So they just thought, oh, just go into treasuries and sit there for 2 years. You lost 22% of gains at 11% a year. What if you put in S&P 500? It was even crazier, 18% a year. S&P 500 in 5 years, you would have more than doubled your money. Your $50,000 investment would be sitting at $114,000. Look at the S&P. I mean, it has little dips, right? But over time, it goes up. So, so the point is, yes, I think the rate is going to drop tomorrow. I think that they're kind of at a crossroads. They kind of have to. I don't think that real estate's only going to go up because mortgage rates are going to come down. So anybody advising you that, seek out a new advisor, okay? I think it comes down to $6.3 trillion is sitting in these funds at these guaranteed perceived rates of return that are really just bleeding against inflation. So that money is going to rush to look for other assets to invest in. It's my Bitcoin thesis at some point. It's my stock market thesis. It's my real estate thesis. So that's what you're going to see. Real estate won't happen overnight. You'll see the stock market and crypto kind of run first because it's always Bitcoin, crypto, stocks, and then real estate. So real estate rides up, the slowest, and it goes down last. Okay. But you will see if the rates come down, all that money will start looking for a home. And it's not going to be one rate cut. They're going to be consecutive over the next few months to the next year or two. I don't think it goes back to zero unless something insane happens, but I think it kind of normalizes in that 2 to 3% range at some point. But that's what it is. That's the facts. We'll see if I'm right or wrong. It feels good to be back. Thank you, everybody. All right. Comment your thoughts. If I'm totally crazy and not right, tell me what you think. All right. We're building our management company. We're redoing everything. It's very exciting. And that's it. All right. I look forward to hearing from you guys. Comment below. Peace.